Best Buy's Q2 FY 2026 earnings. Value play with tariff risks. Hey, deal-chasing investors. Best Buy's Q2 FY 2026 earnings dropped, sparking a 2.51% stock surge. Is this tech retail titan a buy, hold, or watch and wait? Let's dive into the numbers, spotlight growth drivers, flag risks, and map your next move. Buckle up. Best Buy delivered $9.44 billion in revenue, up 1.6% year-over-year, beating Wall Street's $9.24 billion estimate. Adjusted EPS hit $1.28, topping the $1.21 forecast and last year's $1.22. Comparable sales rose 1.6% versus 0.5% expected, with online sales up 5.1%, driving a third of U.S. revenue. At a 12x forward PE and $14.3 billion market cap, it's a value gem. But net income fell 36% to $186 million due to $114 million restructuring costs. Profitability's shaky, so stay sharp. What's powering this? Gaming soared with the Nintendo Switch 2, pushing June sales up approximately 10%, Best Buy's best month since March 2021. Computing hit a 15-year high on AI laptop demand, and mobile phone activations jumped with carrier deals. The new Best Buy Marketplace is a low capex win, and CEO Corey Barry's omnichannel strategy shines. Record low staff turnover and high net promoter scores signal loyal customers and tight operations. AI hardware could tighten that 12 times PE, with 0 to 2% Q3 comp sales expected. This is your growth ticket. Now the risks. Tariffs from China, Mexico, and Canada could hike big-ticket prices. CFO Matt Belluna says Q2 escaped, but H2 could sting. Appliance sales are down in a weak housing market, and a shift to lower-margin gaming and computing cut the operating margin to 3.9% from 4.1%. Amazon's a threat, and cautious shoppers are delaying big purchases. Those restructuring costs hit EPS hard. Watch out, tariffs could squeeze margins if trade talks falter. Domestic revenue grew 0.9% to $8.7 billion. International sales jumped 11.3% to $740 million. Best Buy returned $568 million to shareholders via dividends and buybacks, with a 0.95 quarterly dividend yielding approximately 5%. Great for income seekers. Margins are pressured by wages and tech investments, but AI exposure and retail resilience beat peers. Tariffs add volatility, so brace for bumps. Best Buy holds its FY 2026 outlook: $41.1 to $41.9 billion revenue, 6.15 to 6.30 adjusted EPS, 0 to 2% Q3 comp sales, and a 3.7% operating margin. They're testing IKEA-style store sections and scaling the marketplace. Smart diversification. Holiday deals should boost volume, but thoughtful shoppers and tariffs loom. Hold for the 5% yield and AI upside, or use options to hedge. Long-term, 5 to 10% annual returns if macro conditions cooperate. Best Buy's Q2 beats and 12x PE are a value investor's dream, but tariffs and margins need a plan. Grab shares on dips, diversify retail bets, and monitor Q3 for tariff signals. Bullish or cautious? Share your take. Let's talk shop.